Welcome to The Explainer. Today, we're diving deep into a concept that affects pretty much everyone on the planet, the open economy. So, let's break it down. You ever look at the price of a new phone from, say, Korea or the US and wonder why it just went up or down? Or, you hear about some financial crisis happening thousands of miles away and suddenly the stuff you buy every day gets more expensive? Well, that's not just random chance. It all connects back to a really fundamental decision a country makes, the choice to have an open economy. And that choice has huge ripple effects that touch all of our lives. So what does it actually mean?
Okay, so what does it really mean for our country to be open for business with the rest of the world? Let's start with the basics.
To really get what an open economy is, it helps to look at its opposite. A closed economy is kind of like a hermit. It's totally self-sufficient, no trading, no financial flows with anyone else. An open economy, on the other hand, which is basically how most of the world works now, interacts freely. And we're not just talking about buying and selling cars or computers. It's also services, like IT support from another country, and financial assets, like buying stocks on a foreign exchange.
So, if a country is constantly buying, selling, and investing with the rest of the globe, how on earth does it keep track of everything? Well, it uses a kind of national scorecard. It's called the Balance of Payments, or BOP for short.
Think of the BOP as a country's giant detailed financial statement with the entire world. For a set period, like a year, it meticulously tracks every single dollar, euro, or yen that flows in or out of the country for any reason at all. It is literally the official ledger of a nation's economic life on the global stage.
So what's actually in this ledger? It's really broken down into three main buckets. First, you've got your physical goods, the cars, the oil, the electronics. Then you have services, things you can't really hold, like tourism, software development, or shipping. And third, and this is a big one, is the movement of financial assets, all the investments flowing in and out of the country.
Now, all this international trade means we're constantly having to swap currencies. But that brings up a really fundamental question. Who decides what a dollar's worth compared to a rupee, or what a euro's worth compared to a yen?
That price, of course, is the exchange rate. But it's not like a simple price tag you see in a store. How that price gets set follows two very, very different philosophies, and the one a country chooses has massive consequences for its entire economy.
So on one side, you have a flexible or floating exchange rate. In this system, the value of a currency just goes up and down based on plain old supply and demand. If tons of people want to buy US dollars, the value of the dollar goes up. Simple. On the other side, you have a fixed exchange rate. This is where the government steps in and basically says, one of our currency is worth exactly this much of another, and then it has to do whatever it takes to keep it there.
But, in the real world, things are rarely so black and white. Most countries don't pick one extreme or the other. Instead, they practice what you might call the art of floating, a kind of hybrid system that mixes a bit of both. Let's see how that actually works.
Okay, let's walk through a classic example. Imagine, for whatever reason, there's a sudden flood of US dollars pouring into the Indian market. Basic Economics 101, when supply goes way up, price goes down. So the exchange rate, the value of the dollar, starts to fall. This is where a central bank like the Reserve Bank of India might decide to step in. It'll go into the market and start buying up all those extra dollars. By doing that, it reduces the supply and pushes the exchange rate right back up to where it wants it to be. This act of stepping in, of intervening, creates a hybrid system. It's not totally fixed because the rate is allowed to move around, but it's not totally flexible either because the central bank is actively managing it. And that's how it earned this kind of funny but actually very descriptive nickname in economic circles, dirty floating.
The more official textbook term for this is a managed floating exchange rate. It's the best of both worlds in a way. It lets a country get the benefits of a market-driven rate, but still gives the central bank the power to jump in and smooth out any wild, damaging swings. And this is the system that most major economies, including India, use today.
So, as you can probably tell, running an open economy with a managed currency is a non-stop global balancing act. It opens the door to incredible opportunities, but at the same time, it creates some serious risks that policymakers have to deal with constantly.
So, what are these big risks? Well, for one, if you're not locked into a fixed rate, there can be a temptation for governments to get a little reckless with spending or printing money, what economists call a lack of discipline. And this next one is huge. Being open means you are much more exposed to shocks from the outside world. A financial crisis in Europe, or a trade dispute involving China can send shockwaves through your economy way, way faster than ever before. At the end of the day, that's the deal. Opening up your economy is a trade-off. You unlock incredible opportunities for growth, for investment, for consumers to have more choice. But the price you pay is tying your country's fate much more closely to the unpredictable and sometimes chaotic currents of the global economy.
And that leaves us with a final, really big question to think about. In a world like ours, where money, goods, and information can cross borders in the blink of an eye, how much control can any one nation really have over its own financial destiny?